Hope argues with the tape, and the tape always wins. That single truth demolishes the most dangerous myth in retail trading, that clean breakouts create fortunes, because Richard Wyckoff discovered over a century ago that the market's most reliable reversal signals emerge not from obvious momentum surges, but from the failed breakouts and breakdowns that reveal who truly controls price. Behind every chart stands what Wyckoff termed the composite man, representing the collective actions of banks, institutions, and sophisticated operators who possess the capital and patience necessary to influence market direction. This composite man cannot simply buy or sell massive positions without moving prices against himself, requiring systematic accumulation when the crowd is fearful and careful distribution when the crowd is euphoric. The signature tells become obvious once your eye is trained. Springs that dip below support only to snap back immediately. Up thrusts that push above resistance only to fail quickly, and the quiet tests that follow these dramatic probes. These are not random occurrences but deliberate manipulations designed to harvest liquidity from emotional participants while positioning for the next directional move. The spring represents the market's most generous gift to disciplined traders. A deceptive break below established support that triggers panic selling from weak hands, allowing the composite man to accumulate inventory at discounted prices before the genuine markup begins. Conversely, the upthrust serves as a cunning trap above resistance, enticing momentum buyers to pay premium prices for shares that institutions are quietly distributing, after which price returns to the range and begins its descent. These patterns work because they exploit predictable human psychology. Fear capitulates late, greed commits late, and both emotions are deliberately triggered by operators who understand that the crowd needs confirmation while professionals act on preparation. Consider fire insurance as the perfect analogy for this approach. The rational time to purchase protection is before the emergency occurs, not when flames are already consuming the building and premiums become prohibitive. Similarly, the professional trader establishes positions during quiet accumulation phases rather than during explosive breakout attempts, when risk-reward ratios become unfavorable and emotional decision-making clouds judgment. This requires embracing discomfort as the price of superior positioning, acting when uncertainty feels highest rather than when confirmation feels safest. The psychological element reveals why these patterns remain effective, despite being publicly known for over a century. Retail traders suffer from recency bias, projecting recent price action indefinitely into the future. They experience FOMO during breakouts, convincing themselves that missing the move represents the greatest risk. They anchor to recent highs and lows, preventing objective analysis of developing accumulation and distribution phases. Most critically, they mistake volume and volatility for genuine directional conviction, failing to recognize that heavy effort producing minimal results signals absorption rather than continuation. The composite man deliberately creates these false relationships between effort and result during manipulation phases. Heavy volume with narrow spreads during supposed breakouts indicates distribution in progress. Light volume with significant price progress suggests unopposed institutional movement. Wide spreads that close poorly after apparent strength reveal supply entering the market at elevated levels. These volume signatures cannot be disguised regardless of price manipulation attempts, providing the observant trader with reliable intelligence about institutional intentions. The promise here is mastery through logic rather than emotion, replacing prediction with conditional reasoning and ego with systematic process. You will learn to read the relationship between effort and result, measure the cause encoded within trading ranges, and act where risk is definable, small, and justified by probable effect. This method transforms apparent market chaos into predictable institutional behavior patterns, allowing you to position alongside smart money rather than becoming its unwitting prey. Understanding springs and up thrusts represents only the beginning of this journey. The semantic twist that liberates profitable thinking is recognizing that apparent failure often conceals developing strength, while apparent strength frequently masks underlying weakness. Your job is not predicting these patterns on command, but recognizing the sequence: climax, reaction, test, deception, confirmation, and taking trades only when risk-reward sits heavily in your favor. Comment logic. If this reframes how you see breakouts, because mastering these reversal patterns requires first understanding the immutable laws governing all market behavior, laws that Wyckoff discovered through systematic observation of how large operators conduct business away from the emotional crowd that provides necessary liquidity for their success. Markets operate under immutable laws as predictable as gravity, and Richard Wyckoff's most profound discovery, the law of effort versus result, transforms trading from emotional gambling into systematic observation of institutional behavior. This law states that harmony between effort and result indicates genuine directional moves, while discord reveals manipulation and impending reversal. Effort manifests through volume and price spread, the raw energy expended during any given period, while result appears as actual price progress and continuation, the tangible outcome of that energy expenditure. When heavy volume produces minimal price movement, absorption is occurring as strong hands quietly accumulate inventory from weak sellers. When light volume generates significant price progress, the path of least resistance has been established and institutional money moves unopposed through the market structure. Wyckoff observed that the composite man deliberately creates false relationships between effort and result during manipulation phases, expanding volume and spread without meaningful follow-through during springs and upthrusts. Heavy selling volume that fails to drive prices significantly lower reveals that demand is absorbing supply at those levels. Heavy buying volume that fails to drive prices significantly higher indicates that supply is meeting demand from institutions distributing inventory to eager buyers. These contradictions between effort and result cannot be sustained indefinitely, making them reliable predictors of imminent reversal. The practical consequence is decisive. Traders must stop worshiping price alone and read the volume signature behind it, because these features indicate whether effort is being rewarded or denied. Consider the analogy of a dam containing increasing water pressure behind its structure. The dam appears stable from external observation, but internal stress builds systematically as more water accumulates. Eventually, a small breach reveals the tremendous latent force that has been building invisibly, unleashing a flood proportional to the accumulated pressure. Similarly, accumulation and distribution ranges contain building imbalances that remain hidden until a deceptive probe, the spring or up thrust, reveals the institutional positioning that has been developing during the apparent consolidation period. The complementary law of cause and effect provides the framework for measuring potential moves before they develop. Accumulation and distribution ranges create the cause that determines both magnitude and duration of subsequent trending phases. The longer and wider the trading range, the greater the potential effect once directional movement begins. This relationship is not mystical but mechanical. Larger ranges allow more inventory transfer, creating greater imbalances that require more significant price movement to restore equilibrium. Without a prepared cause, large and durable effects rarely follow. With a large cause, even modest catalysts can unleash decisive moves. Volume analysis becomes the microscope that reveals these institutional fingerprints regardless of price manipulation attempts. During genuine accumulation, volume expands on declines as weak holders liquidate positions, while volume contracts on rallies as strong hands refrain from selling. During distribution, volume expands on advances as institutions unload inventory to optimistic buyers, while volume contracts on declines as natural buying interest has been exhausted. The composite man cannot disguise these volume signatures because large-scale buying and selling requires significant transaction volume regardless of price manipulation techniques employed. Effort-result analysis also defines the danger point, the precise location where risk is smallest because the market has just revealed its hand after a spring. The first low-volume test back into support after an upthrust. The feeble rally that fails to recapture resistance. Entering at tests with predefined invalidation is not prediction. It is conditional logic that converts uncertainty into favorable risk-reward ratios. Observe the spring that pierces support on heavy effort but snaps back to the range with little follow-through. The large effort shows capitulation by weak hands, but the lack of further decline shows demand absorbing everything offered. The psychological element that makes these laws eternally effective is human nature's consistent response to effort-result relationships. Retail traders interpret heavy volume as confirmation of directional conviction, regardless of actual price progress achieved. They mistake activity for productivity, noise for signal, and participation for intelligence. This cognitive bias allows institutions to conduct business in plain sight while retail participants misread the evidence and make decisions that transfer wealth from weak hands to strong hands through predictable behavioral patterns. Wyckoff taught that the market advertises in lies but delivers in truth, meaning that obvious signals often mislead while subtle contradictions reveal genuine institutional intent. The effort-result relationship strips away this deception because it measures actual accomplishment rather than apparent activity. When effort exceeds result, question the sustainability of the move. When result exceeds effort, respect the underlying strength or weakness being revealed. This framework eliminates emotional interpretation and replaces it with objective measurement of institutional behavior. The practical application requires developing discipline to observe effort-result relationships in real time rather than retrofitting explanations to completed price action. Log volume and spread data during key market junctures, compare energy expended to progress achieved, and seek diminishing returns during apparent strength and increasing efficiency during apparent weakness. Discipline reads the relationship between effort and result, while ego reads only price. And this distinction separates professional market participants from the emotional crowd. Comment clarity. If these proportions now read like language rather than noise, because understanding these immutable laws provides the foundation for recognizing how they manifest in the systematic accumulation phases where smart money builds positions while retail traders remain unaware of the developing cause. Accumulation represents the composite man's systematic blueprint for transferring inventory from weak hands to strong hands without bidding price against himself. And once you understand this four-phase architecture, apparent market chaos transforms into predictable institutional behavior that reveals precisely when smart money is building positions for the next major move. The campaign begins with preliminary support, where initial buying interest emerges to halt the decline, but lacks sufficient conviction for immediate reversal, creating the first subtle indication that professional operators are beginning to test the depth of available supply at these depressed price levels. This preliminary buying typically occurs on expanding volume as weak holders continue liquidating positions. But the decline loses momentum as institutional demand begins absorbing everything offered, establishing what will become the lower boundary of the developing accumulation range. The selling climax follows as the emotional purge that converts retail fear into institutional fuel, manifesting through explosive volume, wide spreads to the downside, and panic capitulation by amateur traders who can no longer tolerate the psychological pressure of holding losing positions. Wyckoff observed that this climactic selling serves the composite man perfectly because it provides abundant inventory at favorable prices while eliminating weak holders who would otherwise sell into any subsequent rally attempt. The volume signature becomes unmistakable during this phase. Massive effort produces relatively small downward result as institutional demand absorbs everything forced to market by panicking sellers, creating the classic effort-result discord that signals absorption rather than continuation. The automatic rally emerges almost reflexively as selling pressure temporarily exhausts itself, allowing price to rebound without requiring significant institutional buying and establishing the upper boundary of the nascent trading range. This automatic rally typically occurs on diminishing volume because natural selling has been largely absorbed, permitting price recovery through short covering and modest fresh buying rather than aggressive institutional accumulation. The rally's extent and character reveal critical information about supply. Demand balance. A strong automatic rally suggests selling has been absorbed, while a weak rally indicates overhead supply remains and additional accumulation work is required before markup can begin. Secondary tests provide the crucial confirmation that selling pressure has been absorbed and the composite man now controls available supply within the established range. These tests return price toward the selling climax area on dramatically reduced volume and narrow spreads, demonstrating that natural selling has been exhausted and strong hands are no longer accumulating aggressively because their position building is largely complete. The effort-result relationship during secondary tests provides definitive confirmation. Minimal volume with narrow spreads during the test indicates selling pressure is absent, while any strength emerging from the test area suggests demand significantly exceeds supply at these levels. Within this systematic process, the composite man often employs the spring, a deceptive manipulation where price briefly pierces below established support to harvest resting liquidity, trigger stop losses from weak holders, and acquire final inventory at discounted prices before beginning markup. The spring appears dramatic but proves modest in duration, with heavy volume on the downward probe followed by immediate recovery on lighter volume, confirming that the break was false and all available supply has been absorbed. The test that follows the spring represents the danger point, the optimal entry location where risk is minimal because the market has just declared its institutional intent in plain language. Consider the analogy of commercial construction, which requires systematic foundation preparation, material accumulation, structural testing, and final inspection before occupancy can begin. Similarly, institutional position building follows methodical phases that cannot be rushed without compromising the final result. The selling climax eliminates weak foundations. The automatic rally tests structural integrity. Secondary tests provide quality inspection. And springs offer final inventory acquisition before the markup phase transfers ownership to retail buyers at higher prices. The psychological element that makes accumulation patterns eternally effective against retail traders is their demand for immediate gratification conflicting with institutional timelines that operate on patient capital rather than emotional urgency. Smart money possesses the luxury of building positions systematically over extended periods, while retail participants seek immediate confirmation and abandon positions during the very testing phases that offer optimal risk-reward ratios. This temporal mismatch allows institutions to accumulate inventory from impatient sellers who cannot tolerate the uncertainty inherent in properly constructed accumulation ranges. Common retail errors emerge from misinterpreting secondary tests as renewed weakness rather than strength confirmation, selling into the very tests that represent the safest buying opportunities within the entire sequence. Amateur traders observe price returning toward previous lows and assume the decline will continue, failing to recognize that diminishing volume and narrow spreads indicate absorption rather than distribution. They mistake the quiet, methodical nature of institutional testing for lack of interest. When this behavior demonstrates that smart money has completed accumulation and no longer competes aggressively for inventory, practical identification requires recognizing volume signatures and effort-result relationships that characterize each phase, rather than attempting to predict exact turning points or time completion of accumulation ranges. Focus on climactic characteristics during selling phases, diminishing volume during rallies, quiet testing behavior that confirms absorption, and springs that provide final shakeout before markup begins. Comment patience. If you recognize that waiting for proper tests beats chasing obvious moves, because understanding this systematic accumulation blueprint naturally leads to recognizing its mirror image in the distribution process that transfers positions from strong hands to weak hands through equally methodical institutional selling at elevated prices. Distribution represents the composite man's systematic exit strategy, a methodical four-phase process that transfers ownership from institutional operators to retail buyers at elevated prices, while creating the cause for subsequent markdowns through carefully orchestrated deception that feeds on optimism and confirmation bias. This process mirrors accumulation in reverse but adds layers of psychological manipulation designed to maintain bullish sentiment throughout the institutional liquidation campaign, exploiting retail traders' tendency to buy strength and chase breakouts, precisely when smart money is systematically unloading positions at premium prices. The architecture begins with preliminary supply, where initial selling interest emerges to cap advances and establish the first resistance to higher prices, providing subtle indication that professional operators are beginning to test the depth of available demand at these elevated levels. Volume expands as institutions quietly distribute inventory into retail buying, but the advance loses momentum as supply begins overwhelming demand, establishing what will become the upper boundary of the developing distribution range where smart money conducts its systematic liquidation operation without creating panic among retail participants. The buying climax follows as euphoric purchasing creates unsustainable price levels, manifesting through explosive volume, wide spreads to the upside, and manic accumulation by amateur traders who interpret the dramatic advance as confirmation of indefinite continuation. Wyckoff observed that this climactic buying serves the composite man perfectly because it provides abundant demand at favorable prices for institutional liquidation while creating the emotional peak that marks optimal distribution conditions. The volume signature becomes unmistakable during this phase. Massive effort produces relatively small upward result as institutional supply, absorbs everything demanded by euphoric buyers, creating the classic effort-result discord that signals distribution rather than genuine accumulation. The automatic reaction emerges as buying pressure temporarily exhausts itself, allowing price to decline without requiring aggressive institutional selling and establishing the lower boundary of the distribution range. This automatic reaction typically occurs on diminishing volume because natural buying has been largely satisfied, permitting price decline through profit-taking and modest fresh selling rather than heavy institutional distribution. The reaction's extent and character reveal critical information about supply-demand balance. A sharp automatic reaction suggests buying has been absorbed, while a shallow reaction indicates underlying demand remains and additional distribution work is required before markdown can begin. Secondary tests provide crucial confirmation that buying power has been exhausted, and the composite man now controls available demand within the established range. These tests return price toward the buying climax area on dramatically reduced volume and narrow spreads, demonstrating that natural buying has been satisfied, and strong hands are no longer competing for shares because their liquidation campaign is largely complete. The effort-result relationship during secondary tests provides definitive confirmation. Minimal volume with narrow spreads indicates buying pressure is absent, while any weakness emerging from test areas suggests supply significantly exceeds demand at these levels. Within this systematic process, the composite man often employs the upthrust, a deceptive manipulation where price briefly pierces above established resistance to harvest resting liquidity, trigger buy stops from momentum traders, and distribute final inventory at premium prices before beginning markdown. He observed that the market creates the greatest optimism at the worst prices, and upthrusts exemplify this principle by appearing to confirm bullish narratives, while actually marking completion of institutional liquidation. Consider the analogy of a theater performance where the audience pays premium prices for opening night while the production company quietly sells the venue to new ownership during intermission. The audience remains focused on the spectacular performance, unaware that behind the scenes, systematic transfer of ownership is occurring at peak valuation. Similarly, distribution phases maintain retail focus on apparent strength and positive momentum, while institutional operators conduct systematic liquidation campaigns that transfer positions from sophisticated to unsophisticated hands. The psychological element that makes distribution patterns eternally effective against retail traders is their tendency to interpret failed breakouts as temporary setbacks rather than definitive reversal signals, adding positions during the very tests that represent maximum risk within the entire sequence. Hope and greed blind traders to distribution signals, causing them to purchase precisely when smart money liquidates through carefully orchestrated price action designed to maintain bullish sentiment throughout the institutional exit process. Multi-timeframe alignment becomes critical because institutional distribution on higher timeframes creates selling pressure that overwhelms lower timeframe buying attempts, regardless of apparent technical strength on shorter periods. Common retail errors emerge from interpreting secondary tests as renewed strength rather than distribution confirmation, mistaking institutional testing behavior for genuine buying interest. When this behavior demonstrates that smart money has completed distribution and no longer competes for shares at elevated levels, amateur traders observe price returning toward previous highs and assume continuation, failing to recognize that diminishing volume and narrow spreads indicate exhaustion rather than accumulation, buying into upthrusts that represent optimal short-selling opportunities rather than breakout confirmations. Practical identification requires recognizing volume signatures and effort-result relationships that characterize each distribution phase, climactic characteristics during buying phases, diminishing volume during reactions, quiet testing behavior confirming exhaustion, and upthrusts providing final distribution before markdown begins. Comment transfer. If you recognize this systematic wealth redistribution process, because understanding both accumulation and distribution mechanics naturally leads to identifying the specific reversal signals that mark transitions between these institutional phases and reveal precisely when smart money positioning shifts from accumulation to liquidation. Every reversal signal survives, not because the pattern is magical but because human psychology is predictable, and the composite man designs campaigns to exploit that predictability with clinical precision, transforming logical market participants into willing victims of systematic manipulation through carefully orchestrated price action that triggers emotional decision, making at precisely the wrong moments. Understanding these psychological mechanisms becomes essential because technical pattern recognition alone proves insufficient when cognitive biases prevent proper execution of otherwise sound analytical frameworks, creating the paradox where knowing what to do differs dramatically from actually doing it when real money sits at risk and emotions override systematic analysis. The breakout believer represents the most common archetype, chasing expansion because novelty feels safer than established ranges, interpreting volume and volatility as confirmation of directional conviction regardless of actual progress achieved. This trader mistakes activity for productivity, buying into upthrusts above resistance and selling into springs below support because breakouts provide the emotional comfort of apparent confirmation rather than the intellectual discomfort of acting on contradictory evidence. Fear of missing moves exceeds fear of losing money, creating the psychological foundation that makes false breakouts profitable for institutional operators who understand that retail participants need confirmation while professionals act on preparation. Recency bias causes this trader to project recent price action indefinitely into the future, while FOMO transforms rational analysis into impulsive chase behavior that consistently transfers wealth to patient institutional operators. The anchored analyst defends predetermined bias and refuses the tape's message, retrofitting explanations to support existing positions rather than adapting analysis to developing evidence, because admitting error feels like personal failure rather than tuition payment for market education. This trader becomes emotionally invested in being right rather than making money, holding losing positions through obvious distribution signals while confirmation bias reads, volume selectively, interpreting heavy selling as capitulation during distribution phases and heavy buying as accumulation during upthrusts. Ego prevents recognition that markets operate independently of personal opinions, creating the dangerous illusion that determination can overcome institutional manipulation through sheer force of will, causing systematic wealth transfer from stubborn participants to flexible operators who adapt positioning based on developing evidence rather than defending predetermined narratives. The hero averager adds into weakness because surrender feels like failure, transforming small manageable losses into account, threatening disasters through stubborn refusal to accept invalidation signals from the tape. This trader mistakes persistence for discipline, buying additional shares during distribution breakdowns because averaging down feels proactive rather than acknowledging that the original analysis was simply wrong. And the prudent response is systematic position reduction. Loss aversion magnifies the psychological pain of realizing small losses, while the sunk cost fallacy transforms modest setbacks into crusades for vindication, providing perfect liquidity for institutional operators who distribute inventory systematically during markdown phases to participants who refuse to acknowledge changing market conditions. Wyckoff understood that successful manipulation requires exploiting these predictable human responses through deliberate price action designed to feed psychological weaknesses. False breakouts activate greed by appearing to confirm momentum narratives, shakeouts trigger fear by threatening established support levels, and sideways consolidation breeds impatience that causes premature position abandonment during the very testing phases that offer optimal entry opportunities. The composite man weaponizes time as well as price, stretching ranges longer than retail attention spans and creating quiet tests when few are watching, because the most important signal is not the dramatic probe but the muted response that follows. Practical antidotes require acknowledging that psychological discipline matters more than analytical sophistication, because perfect pattern recognition becomes worthless when emotional interference prevents proper execution. Pre-writing invalidation levels before entering positions eliminates ego-driven stubbornness that transforms small losses into large disasters, while pre-committing to enter only at tests rather than breakouts prevents FOMO from overriding systematic analysis. Position sizing becomes critical because intellectual understanding of patterns differs dramatically from emotional experience of holding positions through institutional manipulation designed to trigger exactly the psychological responses that cause systematic wealth transfer. The semantic twist that liberates profitable thinking is recognizing that the first loss after identifying a distribution pattern represents tuition rather than failure if it reveals the absence of proper testing protocols, because paying once for education remains cheaper than paying repeatedly through ignorance. Wyckoff taught that discipline conquers emotion, logic defeats story, and humility precedes profit, transforming apparent market chaos into predictable institutional behavior patterns. Comment discipline. If you choose logic over emotion, because combining technical pattern recognition with psychological awareness creates the foundation for professional-level market analysis that aligns with institutional money flow rather than opposing it through emotional decision, making that systematically transfers well from retail participants to sophisticated operators. Mastery emerges when technical structure, psychological discipline, and systematic execution fuse into one seamless process, where every decision reflects cause measured, effort weighed, and effect anticipated, transforming the chaotic appearance of price action into readable institutional behavior patterns that reveal precisely when risk is small, defined, and justified by asymmetrical reward potential. This integration represents the culmination of your journey from retail confusion to professional competence, where uncertainty is not eliminated but systematically managed through conditional logic that aligns with smart money positioning rather than opposing it through emotional reaction to market fluctuations. The professional framework crystallizes into 6 actionable principles that guide every market decision with institutional precision. First, observe range development through meticulous effort. Result analysis, tracking volume signatures and price spreads to distinguish genuine institutional intent from manipulative noise, because the composite man cannot disguise the mechanical requirements of moving large capital regardless of price manipulation techniques employed. Second, mark boundaries using volume confirmation rather than arbitrary technical levels, identifying climactic actions that establish range extremes and the automatic responses that define operational parameters for subsequent institutional campaigns. Third, wait patiently for deceptive breaks that reveal institutional positioning, understanding that springs and upthrusts are not random events but calculated harvesting operations designed to extract liquidity from predictable retail behavior patterns. Fourth, demand quiet tests that follow these deceptive probes, because these moments offer the most asymmetrical risk. Reward opportunities when diminishing volume and narrow spreads confirm that natural buying or selling has been absorbed. Fifth, accept risk at danger points where the tape has clearly declared its institutional intent through springs below support or upthrusts above resistance, entering with predefined invalidation levels that convert uncertainty into manageable exposure. Sixth, manage positions for effects consistent with accumulated cause, understanding that large ranges demand proportional moves, while small causes rarely produce sustainable trends, scaling out when climactic opposition appears or measured objectives are achieved. Risk management becomes the cornerstone that enables participation in high-probability setups while preserving capital for the inevitable losses that occur even when analysis proves correct. But timing remains suboptimal. Position sizing must reflect both pattern quality and distance to invalidation, ensuring that individual trades cannot threaten overall capital preservation regardless of outcome, because the market rewards participants who survive long enough to capture the occasional large winner that compensates for multiple small losses. The execution rhythm follows systematic observation rather than emotional impulse. Diagnose the bias through effort, result relationships, wait for institutional deception to reveal positioning, enter at tests with clear risk parameters, trail stops behind structural confirmation, and exit when the logic that sponsored entry no longer governs current market conditions. The psychological transformation requires embracing discomfort as the price of superior positioning, acting when uncertainty feels highest rather than when confirmation feels safest, because the composite man deliberately creates price action designed to feel wrong to retail participants while being systematically correct for institutional operators. Wyckoff's moral framework presents the ultimate choice between joining the sophisticated minority that reads institutional footprints or remaining among the exploited majority that reacts to price action emotionally, transferring wealth through behavioral patterns that have remained consistent across decades of market evolution. This choice demands abandoning the need to be right in favor of the discipline to be systematic, replacing prediction-based gambling with conditional logic that converts apparent market chaos into profitable alignment with smart money flow. Consider the chess master who wins by controlling key squares rather than chasing individual pieces across the board, understanding that positional advantage creates tactical opportunities without forcing immediate confrontation against superior forces. Similarly, the professional trader succeeds by controlling risk exposure rather than chasing price movements, positioning where institutional money flow provides tailwinds rather than fighting systematic manipulation through emotional decision-making. This requires developing patience to wait for optimal setups, rather than forcing trades during suboptimal conditions, because the market rewards preparation more generously than it punishes missed opportunities, and capital preservation enables participation in the next high-probability configuration. The continuous nature of market education acknowledges that even perfect pattern recognition includes losses, because markets operate on probabilities rather than certainties, and professionalism is defined by process adherence rather than outcome worship. Each accumulation and distribution cycle teaches new lessons about institutional behavior, requiring intellectual humility that embraces learning over ego protection while maintaining confidence in systematic processes that have proven effective across varying market conditions. The journal becomes essential laboratory equipment, recording context, entry rationale, effort, result observations, and post-trade analysis, so that feedback compounds skill the way compound interest builds capital, transforming rules memorized into rules lived without theatrical drama. Technology serves the analytical process rather than replacing human judgment, with alerts tracking critical tests, dashboards monitoring volume asymmetries, and screenshots anchoring post-analysis review. Yet the decisive advantage remains distinctly human. Calm attention during institutional manipulation, ethical patience when ranges extend beyond retail attention spans, multi-timeframe alignment adds authority to single-timeframe analysis. Because daily distribution makes hourly strength suspect while weekly accumulation grants credibility to intraday weakness, and harmony between timeframes elevates probability without pretending certainty where none can exist. The volume signature remains the most reliable indicator of institutional intent because large-scale position changes cannot be concealed regardless of fundamental narratives or technical indicators that can be manipulated through financial engineering. Heavy effort producing minimal results signals absorption during accumulation phases. Light effort generating significant progress indicates unopposed institutional movement during trending phases, and these relationships persist across all market conditions because they reflect the immutable mechanics of moving substantial capital without creating adverse price impact. Wyckoff observed that the market rewards patience, punishes urgency, and systematically transfers wealth from the emotional to the logical, creating perpetual opportunities for disciplined participants who understand that apparent randomness conceals institutional behavior patterns that can be recognized and exploited through proper analytical frameworks. The authority of systematic process emerges through consistent application rather than perfect prediction, because markets reward those who align with institutional money, flow more generously than those who attempt to outsmart professional operators through superior analysis alone. Save this method, share these insights with others seeking systematic market education, and comment mastery. If you embrace the ongoing journey of disciplined analysis rather than emotional reaction, because the transformation from retail confusion to professional competence requires not merely intellectual understanding but practical application of these principles during actual market conditions where psychological pressure reveals the profound difference between knowing what to do and actually executing when capital sits at risk and institutional operators systematically exploit the predictable human behavioral patterns that have remained remarkably consistent throughout the entire history of organized markets.